Yeah, so we're gonna, I would love to not be talking the whole time. I would love for people to ask questions, and if you have any information you want to share, please feel free to contribute. People who are zooming in can write in the, is it the chat or the like Q&A chat? Feel free to use chat stuff, and Marcus is here and he can be our moderator. So if people don't know who I am, my name is Annie Moore. I, with Cheryl Noons, run River Queen Greens. And the idea behind this workshop was to present the most basic financial record keeping information that is useful for all parts of life, but specifically we're gearing it towards running a small farm business. And some of this might be familiar to some of you. Hopefully it is, especially if you already have a business. So, but I'm really going super basic. And hopefully it will allow you to be less intimidated by less basic information in the future. So let's start this out. That didn't work. Why does that not work? Okay, I just clicked. Okay, so this is sort of what we're going to be talking about today. What are the things you actually need to know to set up a financial system, by which I really mean like record keeping for your farm business? What are the main elements of a small business's financial records? How do they relate to each other? What goes into a farm's financial records and how to keep track of everything? And then we'll go over some of the tools that we use for managing our finances for the business. And if other people use other tools, I would definitely welcome other suggestions. But this is just my experience. So a couple caveats or a little information about me. I do have an MBA in nonprofit management. So I was looking through the slides that Marcus shared with me from the financial class that the Grow Louisiana folks took last week, I guess. And a lot of that stuff is familiar to me because I did go to business school, but I will tell you that I basically don't use any of it in my day-to-day life. So that's one thing that like I'm sure that it is useful, and it would definitely be useful for like a bigger business probably, but like for really starting out, I'm just giving you the most basic stuff that is what I use. I'm not an expert, I'm not an accountant, I'm not a professional bookkeeper, but I do keep my own books. And those are a couple caveats, and you guys might have questions that I might not be able to answer, but you know, maybe we can sort of work some of those answers out together. Okay. So the big things that we're going to be talking about today are chart of accounts, budgets, and financial reports. Do people have familiarity with these things? I'm hoping that people in the room will say if they know or don't know. Like basic idea of what all of these things are. So a chart of accounts, we're going to go in detail into this, but in general, when you're setting up your finances, just like your record keeping, everything that you input should have a category, and those categories are listed in your chart of accounts. And the chart of accounts is included, like all of the things that you might be keeping track of have a place in the chart of accounts, and then those charts get used in your financial reports, which we're going to talk about soon. It also gets used in your budget. So a budget is basically the same. It looks almost the same as an income statement, but it's a projection of future. So an income statement is a report. A budget is using that report, projecting from your actual report to the projected income or whatever you're going to be looking at in your budget. So the basic three financial reports are income statement. Cheryl, Nora is outside. Our income statement, balance sheet, and cash flow. Cash flow, we'll look at all of them. I'm mostly going to be talking about the income statement, but we'll also look at a balance sheet and touch on cash flow. Cool. Those things all, does that give you a general idea? We're going to be going more in depth, but that's what we're talking about today. What is that ringing? Okay, so chart of accounts. I really love charts of accounts because I like to categorize things. And if you, like you can get real detailed with your charts of accounts, you can also be more general. And the nice thing about them is that it's customized to however you want to be using this information. So you could just say like all of your revenue is one line, and that's okay. It's just going to be harder for you to like, if you're trying to make decisions based on your finances and you didn't like categorize more specifically, you're not going to have quite as much information. But like from a tax perspective, for the most part, it's okay to be sort of general. Oh, I'm going to give examples. Oh, see, this is what happens. Okay, my computer just freaked out. I don't know if this is going to work. All right, we'll see what happens. Okay, so as I was saying, a chart of accounts, but everything that you keep track of goes into a chart of accounts. And you can do whatever you want within that, but you need, everything will go into it. And like if you're using QuickBooks, everything you build out, you build through the chart of accounts. And then everything that goes into that is used in your financial reports. So this is a useful thing that I found that I had on my computer. This is a common list of charts, a chart of accounts for fruit, vegetable, and meat farms. And I can share this with people if you want, but this is just a list. So like, this is just all of the categories that you might use for a farm business. Oh, okay. Let's see. I'm having, let me just, I'm gonna make it bigger. Why is this in decimals? Okay, so the big things of, I actually did, I'm gonna go back to this for a second and go to my next slide, which has the big picture thing. So we're gonna go through the statements, but your chart of accounts is broken into your like balance sheet accounts and your income statement account. So the balance sheet, I wasn't sure how this go. Your balance sheet is basically, it's a snapshot of where your money is, whether you own it or whether it's in a, or whether it's a debt, which is a liability, or whether it's an asset, which could be cash, or it could be your farmland, or it could be your truck, or it could be, these are all fixed assets that I'm talking about. It could be money that's owed to you. So someone, if you have an account at a restaurant, for example, and you sell $1,000 a week to them and they pay you every month, you get a check, then you have $4,000 accounts receivable from that. That's an asset because they owe it to you. And then, so the fixed assets are things like your land and your equipment. It's actually like a physical thing that is not, it's not that liquid. It's not liquid is what, like cash is the most liquid thing. You can like sell it as quickly as you can just move it easily. That's what liquid means. So a fixed asset like land is illiquid because you have to find someone to buy that. So it's just, it's like, it's not as movable, but it has this value that might not be cash value, but it has a value. So that's an asset. So like if you are, I'm going to go through this more in depth later. We'll talk more about the balance sheet, but so all of the accounts, these are like the big general categories in a chart of accounts. Your balance sheet categories, you've got your assets, your liabilities, and your equity. And then the income statement, you've got your revenue and your cost of goods sold and your expenses. And we will talk a little bit more about that shortly. And how do I get out of this? Now we'll just look at some of the detailed things in the chart of accounts. And we're going to be going through these in depth more, but the big picture thing. So as I was saying, like your bank account is basically is your cash on hand. So if you have $30,000 in your bank account, that shows up in your chart of accounts as $30,000 and it's an asset. And then if you have, like I said, like $4,000 that a restaurant owes you that you haven't been paid, so it's not cash yet, but it is actually owed to you, that's accounts receivable. So that's also an asset. And then this has examples of other current assets. So inventory is a good one. We don't really use it for our farm, but if you were this is what's been happening. If you were a meat farm, for example, that had, let's see. I didn't want it to go over there. Oh no. My computer is broken. I don't know what to do about this. I'm gonna have to shut down. It can't project, yeah. I'm sorry, we're having some technical difficulties over here. Let me try closing and reopening this, but I doubt that will work. Okay. Okay. So if you are, I was saying for inventory, if you're a meat farm that has, like, let's say you had a cow that you slaughtered and you were going to sell it and you had like 6 different kinds of cuts. I don't really know much about cow farming, but that you could actually put that in your inventory. And so if you were going to make $10,000 off of that cow, you could have that be an asset because it's money that cow, like, it is worth to you, but it's not cash. Like, what do you say? It's future money. Yeah, but so like we have another little business. We have a little t-shirt business, for example. All of the t-shirts that we have in stock, that's inventory. And you want to be like, when you spend money to buy those t-shirts or to make the t-shirts, and then that inventory is sitting in your closet, you want to have a record of it. It has value to you, even if you haven't sold it yet. So that's the general idea of inventory. It is an asset. I'm not going to, like, there's inventory is a whole big thing that we're not going to talk a lot about. It's not super relevant, I think, for vegetables. The reason is that vegetables, for us, we go so fast through everything. We don't have like a supply of lettuce. You know, that's, you could go and you could say, like, I have, you know, 100 head of lettuce in the field, but we're not going to do that. Like, we might do it if we had like root vegetables that we were going to be storing for months that we wanted to have as a value it as inventory, but that's a little detailed. Just ignoring it. Yeah. So Cheryl asked, what's the benefit of having it as inventory? So if you are looking at your balance sheet and you just spent $5,000 to make t-shirts, that just looks like you spent $5,000 unless you have the t-shirts in there as an inventory. So before you sell it, it was just money that went out the door, but it's not really money that went out the door because you have something that has value still. So you could go and then like really track that inventory. So inventory can be like a finished product that you're going to be selling, or it could be parts. Like if you were a factory and you needed to know, like, and you were purchasing or making widgets, but you hadn't sold those widgets yet, but you'd spent $1 million making it, it would look like you had no money, but you do. You have $1 million worth of widgets. So where does that go? That goes under inventory. It's inventory is really essential for like a business or like particularly a production, like a business that makes things. But it's sort of weird with farming because we're such a high turnover, like high people, things go bad quickly. So we don't have like a big supply of inventory. It's possible that some farms do track their vegetables with inventory, but I don't know. So fixed assets are things, I think a pretty good rule of thumb is if it's over $500 to buy, you can put it in fixed assets. So like, I'm sitting in an office right now with a table. This table probably costs more than $500, and it's something that I could resell. So I would put it as a fixed asset. It has worth to me. It's not just like an expense, like a thing of paper that I might have bought for my office. That's not an asset. I'm not going to be able to resell that paper. It's not going to like last forever. It's something I'm going to go through. So that's just an expense. It's not an asset. So fixed assets are things that like have value over time. And they're things that are going to be what you are like making money off of in the future. If that makes sense. Like they're going to allow you to keep running your business into the future. Does that make sense? Right, like, yeah. So if you bought a tractor for your farm, that tractor is, you don't want it to go as an expense. An expense is something like I was saying, like with a paper, for example, like a ream of paper. An expense is just something that goes out the window. Like the money is gone. It doesn't have any value to anymore. You use that supply, but it doesn't have any kind of like tangible value after that money is spent. Whereas if you purchase a tractor, that tractor has value. So that's why it's an asset instead of an expense. And we'll talk a little bit more about expenses later, but we're going to talk a lot about expenses. But does that make sense? Are there any questions in our things thus far? Okay, so those are all of your, there's also other assets, like then we're just going to get into random stuff that we're not going to bother to talk about, but those are your the asset side of your chart of accounts, which is also showing up, which is also going to show up on your balance sheet. So we're going to look at that more later. So then the other side of a balance sheet is your liabilities and your equity. Liabilities are the same as debt or what you owe to people. So accounts payable, so there's short-term liabilities and long-term liabilities. Short-term liability is if I have an account with a vendor where I purchase, if I'm an animal farm and I purchase feed and I know that I always purchase some amount of feed every month and I don't pay them like with a check every time they deliver, I owe them $500 a month. That's $500 goes in that accounts payable because I haven't paid it yet. So it's something that I owe. Accounts payable is also your payroll generally gets run every 2 weeks. So over that 2-week time period, you're going to be accumulating the liability of paying your staff. So that's also accounts payable. So those are short-term thing. Accounts payable tends like typically like within a month, like debts that are owed within a month. So whether it's to your employees or to a vendor, that's typically what goes under accounts payable. Credit cards, it depends on how you pay off your credit cards, but you might be accumulating some liability on your credit card. So that's a short-term, generally a short-term liability. That's what goes on your chart of accounts. There's other, current liability is what it's called. Ugh. Current liability is what it is called. What the hell is Possum thing? That's cool. So if you had a line of credit, I'm not going to go through all of these things, but yeah, payroll, those are all current liabilities. So long-term liabilities are like if you have a mortgage or if you're paying off the loan that you got for your tractor. Those are things that are more than, you can have like medium term and long term, but I'm not going to go into all of those things, but the general idea there is that those are things that you pay off over years. So that's all, these are all your debts. This is all your liability. It all goes in your balance sheet and it's also kept track of in your chart of accounts. How are we doing? Good. Okay.
have a question.
Yeah.
What do you categorize like seeds? Like, is that accounts payable because you know you're going to be buying them with some regularity, or is it an asset because you know it's going to turn into income?
Okay, so Kyle is asking what seeds are, but so the thing is, seeds wouldn't really show up on your balance sheet. That's going to show up in your income statement, which is where you track your revenue and expenses. And then what happens is that all of those things go into the retained earnings on your equity. So there's not like a line for things like that.
Okay.
In your balance sheet, but I'm gonna what?
But which chart do you put
It's so the chart of accounts has all of your accounts. So you've got balance sheet accounts and it has income statement accounts. Seed is going to be an income statement account. Tractors are going to be a balance sheet account.
I gotcha. Okay.
Does that make sense? And I'm gonna go through other accounts and you'll see how those look too. So,
So that would be, sorry, I'm just trying
no,
to
that's fine.
how
Yeah,
this
this is
breaks
good stuff.
down. But seeds would be, so that's going to be an expense in your list of accounts or your income statement.
Mm-hmm.
But
Yeah,
like,
C's will be an expense in your income statement.
okay, but like diesel fuel, for example, that might be something in accounts payable because you know you spend X amount a month on diesel fuel.
No, that's all going to be in don't get hung up on accounts payable, especially for us. Like, actually, I don't have account. So this is another thing that I think maybe the Maria, the Greek lady, told you about. You can set up your accounts as cash or accrual basis. So a cash basis account is you record the income or the expense when the money is exchanged.
Okay.
And like for us, that's pretty much what we do. Like, I mean, all of our money, like if we buy something, we pay with a credit card, which I pay off within a month, or we give them a check. So that's just in and out. If I were a different kind of business, like most other businesses are accrual, where you would be like selling products that you wouldn't get paid for until down the line. You don't actually record that revenue when you get paid. You record the revenue when you did the transaction, or like when you exchange the service or the product.
Because you know it's money coming.
What's that?
Because you know it's money coming.
Yeah, so you know that the money is coming and it's more accurate in terms of like the way your business is running. Because like I don't want to go into super detail about this, and it's going to get really sloppy when I start talking about it. But the basic idea is like for a business like us, which is a small business, which is very like cash check based, we're not like sending out invoices to be paid back in a month or two. We're more of a check on delivery kind of business. Like if we're selling to a restaurant, generally we want them to pay us with a check when we drop off. If we're at a market, people pay cash when they buy the things. It's just a much more cash-based business. So you don't need to have those accounts payable or accounts receivable as much. Like I basically don't really use those accounts at all.
Okay.
Yeah, I just want to clarify for Kyle. I think what Annie was talking about was like if you have an account with like a diesel fuel supplier because you purchase like 100 gallons a month, but like you don't pay it for the other month. Or like
Yes.
we have like a
yeah.
potty contract. So that's kind of an interesting one that we
Yeah.
probably could put under accounts payable.
Yeah.
Because we pay for that service every month.
Yeah, or like our insurance or things.
Yeah, so it's more like not necessarily something that you buy over like recurrently if you pay for it every time you buy it, but more like if you just pay for it once every 6 amount of time. Like you
Yeah, it's not like we owe the gas station $500 if we know that just because we know we're going to be buying gas from them.
Okay.
That, yeah, it's like if you actually owe this money.
Mm-hmm.
So just in general, like cash reporting, a cash-based system is easier. It's much more straightforward. It's a little bit less accurate, but for our purposes, it's fine. And if you're setting it up, you can consult with an accountant or a bookkeeper, probably an accountant, to find out like what they think. There are some tax ramifications about like when you're reporting things, where like what the money is going to go to, like. But it's generally fine for us. My accountant said cash. Okay. So the last thing that shows up on a balance sheet and in this balance sheet section of your chart of accounts is equity. And equity is like the money that you actually own. So we put, let's say, I'm just going to give a number. Let's say we put $20,000 into the business to start it off in order to buy things. $20,000 goes into the equity section. That's the capital. It's like, that's like the value of the whole business. But then it also goes into the assets. So we'll talk a little bit more about balance sheets, but basically like if you have equity, you also have assets. So it's like $20,000 of equity equals, and I gave it in cash, it's going to be $20,000 of cash, and they're both going to show up on your bank, on your balance sheet. If I gave $20,000 where $10,000 was cash and $10,000 went to purchasing a BCS, you're going to have $20,000 of equity, you're going to have $10,000 of cash and $10,000 of fixed assets. Okay, so that's basic stuff. And then also the other thing that shows up in equity is your retained earnings, which is like at the end of the year or whatever, at the end of whatever reporting period, you're looking at your balance sheet. The money, if you made $500 on December, over the month of December, and you're looking at December 31st, it's going to show up as $500 in this retained earnings thing. Hypothetically, if everything works out the way you want it to. Okay, how are we doing? All right, so now we're going to look at the, just briefly, I'm not going to go through all of these, but so that's all of your balance sheet. Now we're looking at the income statement accounts, and that's made up of your income and your expenses. And we're going to go through this more, but this has like a list of all of the things that you might have as a business, as a farm business. And we're going to go through this much more in depth later on. And like, we don't have all of these things. So you can look at something like this. This is like a comprehensive list of all of the accounts that someone uses. I don't even know where this is from. I'm sorry, I don't have the source for it. But you can look at and say, okay, this applies to me. Like, I know I pay for workers' comp, so I'll put that, I'll have that in my chart of accounts. I do buy office supplies, so I'll have that on my chart of accounts.
Annie, some of this might come from a Schedule F, because I feel like I organize my expenses by the categories on the Schedule F, and a lot of them are similar to this.
And the Schedule F is for farms, right, Maggie?
Yes.
Yeah. So Schedule F is a specific tax form that farms fill out. So there's going to be some, there should be overlap between what that's from and what you're going to be using, or where that comes from and what you're going to be using. When I worked in a television production company, the chart of accounts that we used was like this huge thing that was sort of industry standard for production. And it was all coded by like, there were thousands, 2,000s, 3,000s, 4,000s, and then all of these accounts were like within that. And it was all like 1,000, for example, was like payroll things. 2,000s was like rental equipment or whatever. So it was sort of standardized charts or accounts that had these codes that we would apply for everything that we purchased or made. So this is a smaller scale thing, but it's like that, you know, it can be used. That was just an example of how, like, instead of it coming from a Schedule F, it was from like the entertainment industry standard. Yes?
Can you make up your own chart, your own accounting, or
Yeah. I mean, it probably doesn't hurt to have it be standardized in some way, but like you can have your own sort of variations on it, or you can combine it. Cheryl was asking if you can make up your own accounts. And the answer is like, there's sort of a standard for what these things are, and some things are going to have tax implications, but like if you want to organize it a certain way, you can do that. But they're all based in like the same thing. So you're not like making up totally random things, but maybe you want to combine something like maybe you want your gas and electric to be one account. You can see it, right? Okay. All right, sorry about this. This is not fun. Yeah. All right, we're gonna have to be a little creative. People in the room. You don't have to be on Zoom there. You can just pull it up and just project. Okay. We're gonna talk about budgeting now. Is everyone with me? Okay. So the chart of accounts, like I was saying, is used for it's just how you categorize all of the financial information that you put into your records. So a budget, is that working?
This is working.
But that's not working. Okay. So like I was saying about your budget, it's you take the actual information and then you project off of it. So you can do that in a bunch of different ways. And we're going to look at some examples, but there's some sort of general rules about it, or like ways that you can make assumptions. So you're going to be looking at budget. A budget is basically looking at your income statement and then projecting off of that. So you're going to look at your revenues and say, okay, I expect to make this much money this year, and then I'll make this much money next year, and then I'll make this much money the following year. And there's different ways that you can go about figuring that out. And then same for your expenses, and then those things come out to your net operating income. So a couple of things to keep in mind. Revenue is everything that you make. Income is your revenue minus your expenses, which is not something that everyone knows because they're kind of interchangeable. So revenue minus expenses equals income or profit.
Right, okay.
So profit is not your revenue.
Right.
Profit is after operating expenses.
Mhm.
And we're really only going to be looking at operating expenses. We're not going to be looking at things like your debt payments and stuff. That's not something that I have built in, and I'm not an expert at that at all. But your operating expenses, if you were going to have like the lines on your accounts of like your debt payments and stuff, that would go under your operating expenses, under your income. And then another part of your budget should be your capital expenses. So that's a separate budget. So you've got your operating budget and you've got your capital expense budget. You guys know what that is, what a capital budget would be? Okay, so a capital budget is the things that you buy once that aren't part of your like operation. They help you with your operation, but so I mean, examples of a, I'm gonna go down, where is this? Yeah. Here's your capital expenses generally. For a farm, it would be the land that you purchase. Okay. It would be your barn if you have to build it. It would be your truck. It would be your tractor. It would be land improvements. You know you're gonna have to build a road, that would be a capital expense. It's a one-time thing. It's a big money purchase, and it's not something that you're going to be buying every year. Versus an operating expense is something that you buy continuously. So like if seeds, you're going to buy it once and then you're going to buy it again the next year. So that's an expense. tractor, you don't have to buy again for 20 years. Yes.
So say you buy like a raw piece of land that's like completely undeveloped, but you know you need like a road, you know you need cold storage, you know you need all these things in order to like actually make it run for a farm business. And say that piece of land was like $40,000, you would in your like account, you would also include all of the land improvements, and that would be like what you would keep in your accounts.
Yes. Well, it would be a separate thing. It would be your capital. You'd have your capital budget. All right, this is something that I took from the Carrot Project. Can you guys, I'm sorry, are you able to pull that up?
Yeah, I mean, it's on, but that's.
Okay, that's weird. Okay. That's shitty. Maybe it'll work. Okay, damn it.
This doesn't work on this unplug and we can move the computer.
Okay. Oh, man.
Yeah,
Okay.
I don't know.
So people on the phone, you can see this, right? Yes, they should be able to see it. Okay, so I clicked on, if you go to the next slide, go to that, click on the template there, and then go down to that. So this is, we're talking about the capital expense part right now. So basically you would say, I'm gonna buy a tractor and it's gonna cost me $10,000. That's a very cheap tractor, or maybe it's a used tractor.
Or small.
Okay. I'm gonna buy a truck that's gonna cost me $15,000. I'm gonna buy a BCS that's gonna cost with the, I guess that's under machinery, with the with implements. Well, so a BCS is what, like $4,000 plus $1,000 of implements, for example. So you're just going to go through and you're going to say, what are all the things I'm going to need to buy in a given year? And you might do it for future years too, but you could say, okay, I know in like year 1, I need to buy these things. This is livestock, blah, blah, blah. Right, so you're going to buy your land, you're going to buy your buildings, build your buildings, whatever. All of these things go in. There should be one for land improvements. Yes.
Annie, can I ask a question real quick?
Yeah, please.
So like with a we have a BCS and we have we're paying it off over time. So
Mhm,
we have a loan to buy it.
mhm.
So does that still show up in this part of your budget, or is it categorized differently if it's a loan payment?
It should go in, I believe that it should go in this budget because it is money that you're spending. And even if it's not money that you're, like, it's not your own money at first, it's the value. You're basically saying like, what is the value of all the things that I need?
Yeah.
And then you're gonna look at that and you're gonna say, okay, I'm gonna need to get a $5,000 loan. And then that'll go into your balance sheet as a $5,000 long-term loan or midterm loan or whatever. Does that make sense?
Yeah, thanks.
But it's something you're budgeting for. So even if it's not your money, it's part of your budget.
So this is kind of, I think, similar to Maggie's question, like when you guys bought your tractor,
Mhm.
that went on your chart of accounts as an asset? but then
Yes, also a
as
liability.
because
Yes.
it's bought on credit.
Yes. Okay. Are we going to talk about, do we want to, okay, here. Let's talk about balance sheets. Okay. The fundamental thing that everyone needs to know about a balance sheet is that you've got assets on one side and you've got liabilities and equity on the other side. And they have to, both sides always equal. If they don't equal, then then your balance sheet is off and you have to fix it. You got to balance it. That's why it's called a balance sheet, I guess, because they're balanced. So like I was saying before, if you put $20,000 of your own money in, that's equity, right? And then you have say $10,000 of cash and $10,000 of equipment, for example. What if you put $10,000 of your own money in and then got a $10,000 loan? How much asset do you have there?
10,000?
What'd you say?
10,000?
No, you've got 20,000 because a liability is, what happened to, it doesn't like me putting a plus. Okay, I'll just write plus so you guys can't see this.
We actually.
Oh, screen share. It's so smart. Oh my gosh, you guys.
Way to go, Cheryl.
Plus liability, no, assets equals, sorry, assets equals your liability. Oh, here, I don't have to do it here. I can do it in this beautiful thing. So, oh, look, it did all of this for me. Okay. I don't know what this is. This money that I put in? Oh, it's cash flow. Ignore that stuff. Okay, so this, let's say you put in, I don't know what these numbers are doing here. I was hoping this would be empty. I don't know. It's got a formula on it, but let's just say, okay, $10,000. Oh, look, that decreased the number of that. I don't like this. We're going to start over. We're going to say assets. We're going to have a liabilities column, liabilities, and then we're going to have equity. So this is just your super basic balance sheet. So we're going to put $20,000 of our own money in. This is owner's equity. Then we're going to get a $10,000 loan. Then we're going to have, we're going to purchase farm equipment for $15,000. And the rest is cash. So you're basically, these liabilities, you have $10,000 on hand and you have your $20,000 equity. So that means you have a total of $30,000 assets. Half of that, because I said it, is farm equipment. So then the other half is cash right now. Super basic.
Okay.
Does that make sense though? Like, it doesn't matter if it's a loan, if it's your own money or if it's a loan of money, they have that use to you. So it's money that you're using in your business. It's just how it's categorized as a liability or as equity, and you'll have to pay off that loan. And as you pay off that loan, you'll be losing cash, right? So like, if your loan is now $5,000 because you paid off $5,000, then you're only going to have $10,000 of cash. Does that make sense? This is like this is accounting. So there you go.
You're welcome.
There's all sorts of things. You use journal statements and everything has to, they all offset each other. And I'm not going to go into this, but there's a whole system of journal entries where you say, if something goes up, something else has to go down.
Okay.
So if a liability goes up, your cash goes up. I blah, blah, blah. I don't know. I forget. Too much. I can't go through all of this.
Do we use journal statements?
I do use journal
you have to
entries
think
to
about
make
them?
adjustments. I'll talk a little bit about how I use QuickBooks later, but sometimes I have to think about it. But generally, I use QuickBooks, which thinks about it for me. It doesn't really think. It's not really sentient. Okay. You guys can go back to the workshop. Oh wait, what else are we doing?
We're just a Zoomer.
You're sharing my screen?
They're just as.
We're on-
Oh, they're like those people. Gotcha. God, I'm so stupid.
But we
Okay.
have our camera.
No, you're not.
Okay. Okay. We're gonna go back to this because that was a little side thing, a major side thing. Okay. So we talked about a balance sheet. We're supposed to be talking about budgets though. So budgeting is fun, you guys. You can have so much fun with it. Okay, so the way, I don't know if I want to use this. I want to use something else for the budget, actually. We're going to look at First Root Farm. This is Cheryl's old farm. This, I think, was before you were there. And Nora's old farm. This is the budget from 2013. This is like the superest, most basic way that you can make a budget.
But
And
this farm was fully functioning on this budget.
but it was fully functioning on this budget. So Excel or other spreadsheet software is great for budgeting. You don't need to have like, I don't actually really know how to budget in QuickBooks. I'm sure there is a way. My old QuickBooks, I'm not going to talk that much about my QuickBook woes, but there are budget features that maybe do work in QuickBooks, but I find that it's really helpful to budget through Excel because you can really see everything in front of you and you can like,
Shadow spreadsheet.
yeah, or a spreadsheet. Yeah.
Annie, can you put that in the chat box?
Put what in the chat box?
The link to this.
Yes. Oh, can I share this?
Yeah, are you allowed to share it with us?
I don't know. Well, I don't think it's not like private, but it is our drive. It's in our own Google Drive.
Maybe after. I was gonna say it would just be.
Yeah, well, I can probably like copy and paste
Yeah,
things.
you
And
can-
You
stuff.
can make it a PDF or something, or like you
I
you
can get this information.
so
So
make it
this-
read only or something like that.
yeah, like this is not necessarily how I would set things up. It's pretty rudimentary, but I think what's helpful for it, the best thing about this is looking at how these notes were taken. So I would have a different column thing where I would say just like CSA revenue.
Mhm.
And then I would put in my notes, I would say, I'm expecting to have 115 members paying $650 over the year. What just
You
happened?
put 150.
I put 155. Does that make such a big difference? I guess so. I don't know why it's a different number here.
Because.
Oh,
forward.
okay, so then she took out the work shares, okay. So then you can just go through, so there's sort of two ways to budget. One is to build it from scratch, right? Where you say, here's what I expect to be making. I know I'm going to be selling these many shares, or I know I'm gonna be growing this many tomatoes. And you could say, I know I'm gonna be growing 10,000 tomatoes and I'm gonna sell them all for $4 each. And then you can just say, that's my revenue for tomatoes. Or you could say, I know that, like I think shares are a really good way to do it because it's pretty straightforward. You know that you have like a target for how many CSA members you want, and then you know how much they're going to be paying. That's pretty easy. Or you could say, I expect to be making $60,000 this year. And then you can break it down and say 20% of that is going to be from restaurants, and 50% of that is going to be through CSA, and 30% is going to be at a farmer's market. So you can break it down like that. There's all sorts of different ways that you can do it. Another really, like, I think the most useful way to start your own budget, like if you're starting from scratch, look at another budget. Find a comparable farm, like ask a friend, see what they're doing, know what you're going to be doing that's slightly different because it's not going to be the same, but you can say based on that information, like looking at this, I'll say, okay, this was what 2013 was what First Root's third year in operation. I can say, okay, I expect that in my first year of operation, I'll be doing half of that or whatever. And then you just make assumptions. But it's good to write a note about what those assumptions are and how you came to it.
Mhm.
Like every piece of, like I did in my business school class, we had this financial management budgeting assignment. And we had to build a budget for a nonprofit. And what we did was we took, nonprofits have 990s, which are the financial reports, and it's all public information, so you can get it off of the internet. So we had to find 3 comparable nonprofits for like the kind of programming that we were going to do. And then we looked at their income statements, and then we said, okay, we did some research about them. We said, okay, they are making this much money. I think that in this year, I should be able to make this much money too, or whatever. So you build it and then you just make an assumption. You just say why you made that decision in your assumptions thing. And then you can just build it out from there. And then, so this was the income account. Then she said, so for the salary, she was like, I know I'm going to have 2 full-time workers. They're going to be paid. You might want to have a separate budget for your salary where you say, you know, how many workers, how many hours, what their rate is. And then you just multiply that and put that in your salary. Put it in there. And then you want to add some extra money for the taxes. It's generally about 10% extra for payroll tax. So if you know you're going to be spending $30,000 on someone's salary, add another $3,000 for payroll tax. That's pretty good rule of thumb. And then, yeah, so then she just went through, and all of these different accounts here are all parts of your expenses. And then she estimated that she didn't actually do it. That's funny. She didn't estimate what her profit would be, but it would be total income, which should be revenue, not income, minus total expense,
0.
equals how much money were they making? $50.
$50.
Hell yeah.
She also did something that most farmers don't do,
She paid herself.
which pays herself as a salary.
Yeah, so her own salary is included in that salary line. So the farm basically broke even, but she got paid, and she
The
paid
farm
other
didn't
people.
make money, but she did. So
Yeah,
that's great.
that's
For
great.
year 3.
That's brilliant. That's a dream.
Why is it that most farmers don't do that?
Because there's no money to do that.
Well, there's different, yeah. So a lot of farmers will do an owner's draw, or they'll just take whatever money is left at the end.
Okay.
But if you put yourself on payroll, then you have to pay payroll taxes, and maybe you don't want to do that. Maybe you want to be paying in the taxes in a different way.
Gotcha.
So you can talk to an accountant about what makes the most sense for you for compensation. What else was there in here that I thought was helpful? Ooh, yes, we're gonna look at that later. Okay. No, it's fun, I promise. That was a cash flow, Chelsea. It's really exciting.
You see all that, right?
Okay. This is what I wanted to show you here. So we're gonna look at this template and just fill in a couple random things. So let's say we're selling at a farmer's market, and year 1 we expect to sell $10,000. Then so they've built this template here, which I think is really useful, and I'll definitely share this with people. You could build it yourself too if you want, but they've already done it, so why reinvent the template? So then you can decide how you want to estimate. Some people would do, this is kind of weird. Okay, so I'm going to expect to increase my farmer's market sales by $5,000 each year. You can see in the next line, it shows $15,000 in year 2, $20,000 in year 3. You could also do it by saying, I expect to have a 20% increase in sales each year. So this is just a sheet that's built for you to be able to plug in numbers and create your own budget. And you could also extend it if you want to plan for year 5, go for it. I think it's helpful also to write a note about where you get these, because these percent increase or these expected annual change, that is all coming out of your nowhere. You're just pulling that out of whatever. So it's a good idea to make a smart assumption. And you might do that based on looking at previous years. If you're in year 2 and you say, well, last year I had a 20% increase, maybe I'll expect to have a 20% increase this year. Or maybe you can say, I grew on an acre this year, but next year I'm going to be growing on an acre and a half. So that means that you're going to have a higher yield and you could have higher sales. And so you can think about that when you're factoring all of that in, when you're building out your budgets for the following years. Does that make sense? I think that the revenue side of budgeting is sort of the simplest and most fun, and you can really make stuff up. But hopefully it's useful. Okay. Now we're gonna
close to the reality.
but honestly, I don't spend that much time budgeting because I do find that I'm really kind of, it's just coming out of my holes, but but I do want to say budgets are really important for showing to potential funders.
Mhm.
And that's where it's really helpful to have those assumptions, like with a decent explanation of how you're going to get there.
Right,
So it's not just blowing smoke.
right.
You know, you want to be able to have it. So like, I haven't personally had to go to a bank with a budget, but if I did, I'd have to have a really good budget, you know? So like, I did it for myself when we were starting, like, what are we anticipating? I looked at some comparables. I looked at First Street. That was helpful to have. And then I looked at some other places. I'm going to show you some other links that you can look at in the future. But yeah, it's just good to have sort of a basis to start from, and then you create your own budget. One thing I want to point out, which I think is sort of one of the funner parts of budgeting and thinking about expenses, is the difference between fixed and variable expenses and direct and indirect. Ooh, direct and indirect. Okay, does anyone know what I'm talking about?
Maybe.
No, Maggie, come see, come saw. I don't know anyone else because I can only see Maggie. Okay. So a fixed cost, does anyone have a guess of what a fixed cost might be?
Because it's not gonna change.
That's not a variable. Your mortgage?
Consistent
Yes,
on a regular basis.
yes. So a fixed cost is something that over time, if you're looking at your budget and you're trying to say, how much money am I going to be spending in year one? How much money am I spending in year two? It should be the same. So there's some examples of this, like a fixed cost would be rent. If you know you're going to be spending $100 a month in rent this year, and as long as, you know, there's not some change in whatever, it should stay the same. That's what you're like fixed in at. You're going to be spending the same amount in rent every year, no matter what your output is. Okay. A variable cost is something that's going to be dependent on what you're producing and selling. So seeds are a really good example of that. If you are growing more vegetables, you're going to be buying more seeds. So as you expand, if you're saying you're going to be selling 5% more produce, then you probably want to add 5% more seeds when you're budgeting out your expenses.
And the really fun part comes when trying to not have 5% equal 5%. Because maybe you can
Right.
improve your yield
Mhm.
with what you're already using to grow more.
Right. So variable expenses are also, I mean, in both cases, you can be thinking of like, where can I cut costs? And maybe there's something called, what the hell is it called? As you start spending more money, maybe the cost goes down. There's a term for that that's very common, and it's slipped my mind. It will come to me. Basically, like as you get bigger, like, I mean, you probably, if you ever like bought bulk t-shirts from a place for your soccer team and you saw it was cheaper per t-shirt to buy 20 than to buy one, that's true for like most things that you're going to be buying. So it is
Definitely
true.
of seeds.
It's definitely true of seeds. If you're buying 5,000 seeds instead of a little packet of seeds, it's going to be less per seed.
Economies of scale.
Yes, economy of scale. Thank you, Marcus. I knew that you would know this. Crying out loud. Okay, economies of scale for those on the call. So fixed and variable. So you can go through here, and this is sort of a fun exercise. I'm not going to do it all, but you can go through and say, like, what's a fixed cost? What's a variable cost? Because it's something that you should do if you're budgeting and you've listed out all of your expenses. You want to know basically what that is. And there's some variation, like generally rent is a fixed cost, but, oh, I need to expand my business so much that I have to rent a new lot. If you're doing urban farming or whatever, that's going to increase. So it might change sort of after a certain jump. So that can happen in different places. Like if you're looking at labor costs, a manager, like a traditional manager versus like hourly labor. Hourly labor tends to be direct because they are doing, like, an hourly worker at your farm is doing the work of producing those vegetables. And the more workers you have, the more hours they spend, the more vegetables. So the more sales, the more expense, more labor expense, versus having your farm manager. They're just hanging out there no matter what the production is, right? Like, if you have a salary for your manager, that's generally going to be a fixed cost. But like I said, there might be a jump because you're going to be growing so much more stuff, you're going to need to hire a second manager. So that might change too. But that's just things to think about. You've got your direct labor, which is a direct cost, and then you've got your indirect labor. This is where I said indirect and direct. Your indirect labor is your generally like the manager's salary. So like if you're in a factory, your direct labor are the people on the floor doing the work, and the more work they do, the more stuff you produce. Your indirect labor is the manager who's hanging out doing office work, and it's not tied directly to the work to the production that you're creating at the factory. So there's indirect and direct labor, and then there's like materials. So this is sort of interesting. Like direct and indirect materials are things you talk about a lot for like a factory. So like if you're producing widgets, for example, you would have your, like, all of the individual parts are the materials. But if it's like a bucket of glue, that's a tiny bit is going to go into each part, but it's not like each part has its own like quantifiable glue amount. That's indirect materials. So for a farm, we can come up with something. What would be a direct like material or supply?
Compost?
Indirect.
That's
Is
indirect.
that what you're saying, or direct?
I guess it would be indirect. I was thinking direct, but yeah.
Kyle is saying compost. I think rubber bands is my favorite example of a direct material for farming, because like if you have a $3.50 bunch of kale that has a rubber band on it, you're actually only making $3.29 or whatever, you know, like there's some amount that's direct, like each thing that you're selling has that rubber band on it. So that is a direct material. Versus compost, well, I think that's sort of I was thinking about this. I think compost might be sort of an indirect thing because you spread it over everything and it's not directly tied to the, like the nutrients from the compost isn't associated with that kale bunch. It's associated with all of the plants that it's planted in. Is this fun? I think it's so fun.
It's way better than what you've ever experienced in your finances.
Okay.
Yeah.
Okay, so direct and fixed and sorry, direct. Oh, actually, this is true. Fixed and direct tend to go together. Nope, opposite. Variable and direct tend to go together, and fixed and indirect tend to go together. And I think there's some specific things in managerial accounting where you have to like be doing math based on these things, but I'm just introducing these terms as a way to think about your expenses. So when you're looking at, so let's look at this.
Can you say
Animal
it again? What did you say?
What'd you
Can
say?
you just say which ones are associated again?
I'm gonna move this because it's the opposite.
Oh, okay.
Variable and direct
Cool.
are more likely to be associated. So, ooh, animal feed. This is fun. Actually, that's a good one. I like that one. What would animal feed be? Is it a direct or an indirect expense?
Direct.
Direct?
Right?
Because I mean, if you don't feed the animal, the animal
Yeah,
will not be
there's
able to
no
look out for it.
operation. And you should be able to quantify how much feed
Yeah, because you don't want
is
to
required
overfeed
to
or
get
underfeed.
you.
Oh, that's really
One you
hard.
animals more hungry, and then one
Yeah,
doesn't
I
get
think
bigger.
that if I
They
were
get bigger.
if
So
I were
they-
doing my animal farm budget, I would say that animal feed is probably fixed and direct, because you're going to be basically giving all of the animals the same amount of feed.
Like you can, there are formulas that convert specific quantities of feed
Okay, so
to
maybe,
specific
yeah.
outputs of certain animals.
Okay.
It's not,
so maybe
perfect.
animal feed isn't the best example to start
But I
with.
did hear somebody say like the animals get older, and like that is traditionally what we have done is gotten very small chickens. You raise them, that does significantly change
And how much food they eat.
how much food they eat. Yeah.
I don't know. Anyway,
It's
so
interesting
the
how
reason
you
I'm
do that.
doing this is just to introduce these ideas to you. I'm not going to have the like final answer for what all of these expenses are, but it's ways to be thinking about it. So let's do something that's maybe a little easier. Organic certification. I don't know why this is under direct operating. I wouldn't have put it under direct operating. What would you call organic certification? It is a cost. Is it direct or indirect?
Direct.
I would say indirect.
I would say indirect too, but they have it here under direct operating.
Why would you say indirect?
I would say indirect because it's not really associated specifically with your output. It's like the cost of getting a certification is just kind of like an administrative expense in the way I think about something like that. I mean, you could say because you're going to be able to charge more money for it. Maybe that's why it's a direct operating thing, because like something that's organic certified will increase your revenue hypothetically. I don't know. That's sort of a gray one too, but it's definitely fixed. It's definitely a fixed cost. You spend your certification, you spend, I don't know how much organic costs, $1,000 a year. And no matter how much output you have, you're spending $1,000 per year. So that's just a fixed cost. Make sense? Let's see some other interesting things. Or maybe we're done with this. Are we done? Oh, insurance. This is a good example too. What's insurance? Is it direct or indirect?
Something like
It's indirect, right?
Indirect.
I would say indirect.
And does that apply? To all?
I would say so. Yeah. I mean, maybe you could be really nitpicky and say like your workers' comp goes up if you have more employees because you're doing more work or something. Like maybe there's some exceptions, but in general, like let's just say general liability insurance. Again, there might be a jump as you like have a bigger business, but generally it's a pretty fixed cost from year to year. Like maybe in 5 years you're going to be spending more, but as a general concept, insurance is like a standard fixed cost. Yeah. Office supplies are also a good example of a fixed cost. Like there might be some variation if you're printing a lot of letters because you're doing a lot of marketing or something. And so you're going to be spending more money on paper, but in general, it's like pretty consistent year to year. And you can just say like, you just have your $5,000 budget for office supplies and that can just be consistent every year.
So you wouldn't put like rubber bands in office supplies, even though they're
No,
office
rubber band,
supplies.
right, rubber bands, right. So that's sort of interesting when you're coding different things. We're going to talk a little bit more. What time is it? Oh, we've got time. We can keep talking about this forever. Watch out. So yeah, I mean, then you have to like, when you're purchasing, when you're looking at your receipts and you're saying, what did I buy? And how am I going to be using it? So a rubber band, you might be buying it from Office Depot, but you're not using it for the office, you know? Hi,
Yeah, I'm that one.
what's your name?
Madeline, Marcus will be stuff up.
Oh, okay, cool,
She's in our cool.
Or Louisiana.
great. I'm afraid that our projector isn't working, so.
Oh, that's okay. I can-
Do we want to do it? Does anyone else have anything they want to talk about that they see on this list here? Oh, telephone. Your cell phone bill. What's that?
Indirect.
fixed indirect. Yeah, that's a good example of something. You're gonna be paying the same unless you're like on an hourly plan, which you probably aren't if you're like working at a business. That's gonna be the same rate every year, no matter how much business you're doing. But then, what's that?
I have a question
Yes.
quickly. I don't know if you already talked about it, but could you talk about depreciation? Because that's something that I've never really understood very well, how you keep track of that or factor that in.
Yeah. Okay. You really want to get into depreciation? Let's do it. Okay. All right. Again, not an accountant, and you should have your accountant really be doing the depreciation calculations, but the general idea of depreciation is that all of your assets, your fixed assets typically, your fixed assets depreciate over
So
time.
like your vehicles, your equipment.
Right. So your building, your land is, I think, an exception. I don't think you depreciate land. But anything that has a lifespan that's more than like a year or 5 years, I don't know exactly what the rule is. There's probably a rule. But anything that has a lifespan over a certain amount of time needs to be depreciated. So going back to the balance sheet, you've got you have your $10,000 worth of farm equipment. That's an asset in year one. You actually want to start writing it off because it was money that went out, and you should be getting a tax write-off because, sorry, I feel like that makes things more complicated. Basically, you spent that money, right? But you don't spend it all at once. You spend it over time as the use of as the value depreciates, depletes. So a vehicle that you bought 10 years ago is not worth as much now as it was 10 years ago, right? So if you bought it year one, I'm gonna start writing off. Year one, 1, 2, 3, 4, 5. Okay, these are your years. Let's say you purchased a truck that was $20,000 in year one. And you also have a tractor that was $20,000 in year one as well. So what you do with your depreciation is you gradually take the value out of your fixed asset account in the balance sheet and move it into your expenses. So you'll see under this operating expense, I don't know why they have it under direct operating, but you'll see listed here, it's an expense, it's not an asset, but that's actually coming from the assets. So your truck in year two, if you're doing a 5-year depreciation, like flat rate, there's different ways to do it, but let's say it's a 5-year flat rate depreciation where every year it loses 1/5 of its value. What's 1/5 of 20? 4,000. So in year 2, your truck is actually going to show up on your balance sheet as worth $16,000, and you'll have $4,000 of depreciation expense.
Okay.
Year 3, it's going to be $12,000, and you'll still have, and it'll be another $4,000 because it's cumulative as an asset, but it's as the expense goes out, it's a one-time expense, and then you record it again the same way next time. And you do it once a year. And this is what, like, we have an accountant who does our depreciation schedules. So different things are going to have different terms, like different lengths of depreciation. Like a building might be like a 50-year depreciation thing, but a vehicle might be 10 years, or a tractor might be 20 years. And then after it depreciates, after that 20 years, you can still be using it, but it just doesn't show up as anything. It's just,
Okay.
it doesn't appear on your records.
It's no expense and it's also.
There's
not
no
an
expense.
asset.
Right. And the reason that you want to depreciate it, I started talking about write-offs, which I'm terrible at. But the general idea is you want things to show up as an expense because then you don't get taxed on it. So you want it like your accountant might say, oh, actually it makes more sense to depreciate it sooner because you want to get more tax benefits now than later, for example. So that's super basic depreciation, but that's the general idea. Does that make sense?
So your first year of owning your new tractor, you would not write any of that off on your taxes because you haven't depreciated.
I was just saying that, so the first year in business, you probably are gonna have zero depreciation expense. But your second year, you're gonna start depreciating. I mean, it's possible you might do it every month or something, but that's kind of unnecessary.
It can do partial depreciation. So the tractor halfway through the fiscal year, you can count the depreciation for those 6 months that you did own it within the fiscal year that you counted.
Yeah.
But that's just kind of a preference.
Yeah, it's sort of like Marcus is just saying, like, there might be a situation where the timing works out that you might want to depreciate it if it was like 6 months off or whatever. But like in general, I think just the simple way to think of it is that every year it's going to depreciate. Like after the first year, it's full asset. The second year, it's mostly asset, and then one part of it is depreciated, and then it balances out so that you've got the asset value goes down and the depreciation expense over time has increased.
Okay.
And where do you determine the depreciation rate?
Depreciation rate, there's some sort of standards, I think. You can probably look it up, but I think that in general, well, the depreciation, like the time, how fast you depreciate it,
Yeah, like how do you know whether to depreciate your
like over 10
tractor over
years.
10 years at 20% each year, or 10 years at 10% each year, or whatever?
So there are sort of standards, I think, for like equipment, like tractor might be 20 years. But again, this is where you might want to ask your accountant how they want to do it. And there's also a way to do it. There's straight line depreciation, and then there's a different kind of depreciation where you take more out early on, I think, and then it's like smaller later. But that's all like,
The client balance is based on the beginning year book value of the assets. And so the first method that Amy talked about is the straight line. And so it's based upon the cost of the asset at the beginning. But the other method, which is a little bit more difficult in the calculation, the declining balance is based upon the book value of the asset at the beginning of each year. And so in year one and year two, you have depreciation. And so the beginning year book value in year two is you take that depreciation and subtract it from the cost. And then now that's your beginning year book value. So it continuously declines. The depreciation is calculated differently each year based upon what the value is at the beginning of the year.
Gotcha.
yeah. So Marcus was just, I don't know, can people hear Marcus? Layla, I can see you. Did you hear Marcus? No. Okay. So Marcus was saying there's two different kinds of depreciation. One of them is straight line, which is what I was describing, where every year you take the same amount out. The other way is like book value depreciation, where you, because you've taken some value out, then you revalue what the total of the asset is, and then take the depreciation off of that value. But this is like pretty detailed stuff that, again, like you don't have to know right now. Like it's helpful to understand the general idea of depreciation, but like that your accountant or whoever can make those calls for you or suggest how they would do it.
And it's also just perfectly acceptable to do flat line, right?
Yeah,
Like,
yeah, it's all
there's no
like
wrong way.
it's like how you want your taxes to look at the end of the year. It's how you decide to do it.
I guess it's interesting because I didn't realize that like when you're doing the straight line depreciation or whatever that's called, your first year you wouldn't be able to write that off on your taxes at all. So like if you're buying something on credit, that would be okay. But if you're like, say you spent 20,000 cash, that could really hurt come tax time because then you're not able to write any of that off, but you just spent down like a bunch of liquid assets to buy that thing.
Yeah.
So then you might want to do something different in your depreciation or something like that.
Yeah, you can. Yeah, but
It just depends on how deep.
really, yeah, like depreciation, the general idea of it is that you're you're taking the value that's in your assets and turning it into an expense over time. And that by turning it into an expense, you write it off, because the more you spend, the less you get taxed on your net income. Cool, but you can't, like, the government doesn't allow you to say that you spent $20,000 in a year on that tractor, because it still has value to you.
Okay.
Okay, what's next? I'm gonna move forward here. Any other questions from,
I actually had a quick question, Annie, about things like maintenance and repairs. How do you budget for that kind of expense when you don't necessarily know what it's going to be? Like if you
Yeah.
don't know that a storm's going to come through and rip up your greenhouse fabric, like how do you plan for that sort of thing?
I think in general, you just have like a fixed line. You just say, based on previous years or based on what other farms do with similar size, they have $2,000 of expenses in their budget. Yeah, I mean, yeah.
Just ballpark some number and then hope for the best.
Then, you know, some years you'll use less and some years you'll use more, you know. I think that's generally the idea. There's not.
Is that kind of the same deal with like crop loss? Like, do you factor that in before into your, like, when you're doing your crop planning, I guess? Do you like factor that in and then it becomes part of your income in a budget? Or is that like part of like the line that you were just saying that's just like emergency, it's going to be baseline like $2,000 a year or something?
Well, I wouldn't put crop loss under repairs and maintenance. Crop loss, I think it's more like, I don't know. I mean, do farms put crop loss as an expense? I'm asking Marcus this, or is it
I
just
think it depends on
factored
how
into your
how you
revenue?
utilize the insurance. If it's lost revenue, is what it would be.
Right? Yeah.
It's not relevant for us. Like, we're not insuring like 1,000 acres of one crop.
Yeah, we don't have crop insurance. I think generally, like if you're thinking about it in terms of like your seeds that you're purchasing, and that some of them or whatever space is being used isn't going to materialize, it's just going to be less revenue, I think. I mean, maybe there is a way to calculate it as a cost, but that's not something that we've ever done.
We just factored into our crop plan, Layla, where we will, like, I don't even really do it that formally. I just kind of round up when purchasing seeds, because, you know, seeds come in fixed quantities, and usually the quantity that I estimate we need is not that exact fixed quantity. So I'll just kind of round up on our plug trays, you know, and it all factors into about like a 5% to 10% buffer, which then just kind of evens out. But we don't budget for it.
Yeah. Okay, that's all we're gonna do with budgets right now, I think. Did I cover these things? Whew, how are we doing? I haven't even gotten to my beautiful income statement stuff. Okay. Okay, so we're gonna start talking about some of the reports. Actually, we already talked about balance sheet, so that's good. The income statement is the report that I use the most. It's the most, like, you run it the most frequently to see how much you made in a given time period. That's what an income statement tells you. It's tracking profitability over time, and you can do it, you can set it for a specific time period. So you could say, how much did I make in January? Or you can say, how much did I make in my fall season? Or how much did I make in 2019? And it collects all of that information into one report. And it basically looks exactly the same as a budget, but it doesn't have those lines for the projection. So like your budget, if you look back at our Carrot project budget, year one, that's not good. This is all budgeted, but if you were to have your income statement, which we will be looking at, I'll just pull up this. Ooh, we're gonna get real. We're getting real numbers, folks. We're getting personal. Okay. So this is our profit and loss statement for 2019. These are the actual numbers. So if this were a budget, these would be projected numbers. Oh, sorry, Christian. The projected numbers would be like year 1, year 2, year 3, or whatever. But this is the actual numbers of what happened in the past. So it's really useful information to know. So this is like how you want to categorize everything using that chart of accounts that we looked at. So you know, okay, how much money did I make within a given time period selling whatever I was selling, or how much did I spend within a given time period on whatever I was spending money on? And then how does it all add up? We're going to look at in detail on some of these different categories that are found in an income statement. The first being revenue, that's the top line. It's all of the money that comes into your business, all of the inputs. And there's different ways to categorize them. I think this is something that I've been thinking a lot about, because I'm looking at these different sheets and they do a little bit differently from me, but the way I do it is by sales outlet. Like I want to know how much money did I make at a farmer's market? How much money did I make from restaurants? How much money did I make from CSA? Some farms will say, how much money did I make on eggs? How much money did I make on dairy? Like for us, that doesn't really matter. Like we only sell vegetables pretty much. And we're not selling like 3 kinds of vegetables. We're selling like 50 kinds of vegetables. So I don't need to have a record in my income statement of how much I sold, how much money I made on cabbage this year. That's something I can track in other ways, but it's not how I need to track it in my income statement. So and again, this depends on your operation. If you're going to be like a truly diversified farm where you've got meat and dairy and eggs and vegetables, you might want to track that all in your income statement, as those are your revenue categories.
Can you do a combination, or is that like gonna mess things up? Like I was just thinking about our business. We definitely have products that we sell, I don't know, that have their own ways of us selling them. Like we do plant sales and we do them at the farm, or we sell ginger and turmeric and we sell that wholesale, but then we also go to farmers markets and we have a retail outlet. So is it like,
yeah, so I
product and also sales outlet, it feels like, or
yeah, and I think that's a really good example, because it's sort of like equally important information for you, right? Like you have like 3 different sort of categories, like big categories that you're selling. You're selling your nursery stuff, you're selling your meat or egg stuff or whatever, and you're selling your plant stuff, for example, right? And those are sort of 3 big categories, and you do have different sales outlets. So there's probably different ways to do this. In QuickBooks, something that they have is classes, which is a really nice way to break it down further. So you might say like, actually, I'm going to look at this for my example. I have my classes broken down into things that are specific for us. And you don't need to do classes, but this is just one way to do it. So let's say you wanted to find out how much you made. You could change these classes to be, you've got your produce class and you've got your nursery class. What are your other things, Maggie? Like what are sort of
produce, nursery, and then I said ginger and turmeric kind of exists as its own, like it's like wholesale. Let's just say ginger and turmeric.
Wholesale, no, but what products? Give me products. Are there specific products? So it's basically ginger turmeric. Okay.
I know it doesn't fit into it. It just doesn't. I don't know.
You might actually not need to, because we're going to categorize this in another column.
I guess, yeah, you can break produce down further and do.
I wouldn't do that.
Markets? Oh, no subcategories?
What I'm saying, you can break this down so that you've got your column here being your, whoops, that's not what I meant to do. What did I do? But then you can still have your market sales and your online sales here. So it's broken down. You've got your columns and your rows. That's what classes allow you to do. So you could say, how much did you make at the market selling your veggies? I made $5,000 at the market on veggies, and I made $2,000 selling nursery items at the market. And I didn't make any money on ginger and turmeric at the market because I don't sell it at the market, but I do sell that wholesale. So that would go here. I made $1,000 in ginger and turmeric wholesale. Oops, that's not the right column. Does that make sense?
Yeah, it does.
So you can further break it down that way. You could also do it like you could have sub things where you have like your market sales, and then you could have a sub account for that where you have produce, nursery, and GT. And then you could have your wholesale, produce, ginger, produce, nursery, and GT. Does that make sense? So there's sort of two ways that you could go about doing it, I think. Like all in one line where you stack them and you subcategorize them, or as classes where you have like a different column for each thing. And you could do it the opposite way. You could have market, you could have this be market here and this be wholesale, you know, and then have your produce going down that way. But does that sort of answer those questions?
Yeah, that was very helpful.
Okay. But so as I was saying, for us, our business is like entirely vegetable. So I don't need to break it down by item on my income statement. I do like to have that information elsewhere. So like when we're at a market, we have a square reader, and I will put in all of the things we sell so that there's actually a report that I could generate of how many carrots did we sell over a period of time. But I don't need that super specific information in my income statement. I just want to know how much I made at markets in general.
Wait, you use your Square and you would like enter your cash sales into Square as well, and it generates a report?
Yeah.
I got to do that.
It's not a bad idea. I mean, you can get by without doing it, but if you want to be pretty detailed about what you're selling, it's helpful to have that information. You don't have to use Square, you could use something else. I think Tom from Vic
Yeah.
writes it down on a piece of paper. I don't know what he does with that, but.
I mean, right now we just keep a Google spreadsheet of that broken down by like cash, Square, Venmo, because that's how most of our money comes in. But it doesn't break it down by like specific product, you know, so it could stand to be.
Yeah.
And Square just doesn't work.
Yeah, Square. Yeah, I mean, you have to set it up in Square so you have all of your products listed. But we're sort of diverging. But in general, like all of this information is stuff that you decide how much detail you want and what is relevant for your own operation. So this is what we have as our income things. We've got donations. That should really be grants. Because we've gotten some money from like NRCS grants. That is an income. That's income. Events, that is something that we tried to do and haven't done since COVID, but blah, blah, blah. Okay. Market sales is the big one. Online sales is something that we do with our other business, Rutabaga Bodega, which I'm not going to talk about. Although everyone should buy some great holiday items for their family, all you veggie enthusiasts. So the big things for us are market sales and wholesale. This is in 2019. We now have 2020 looks different because we had a CSA and that changed things, but that now has its own account. Okay. And then so then we've got our cost of goods sold. Does anyone know what a cost of goods sold is?
Cost of the t-shirts you bought. The cost of the bags that we.
Can you hear Cheryl?
Is that
People,
right?
Maggie's shaking her head. Yes. nodding her head.
So like those little trays, you put the microgreens in it and you use too.
Okay, so here's the thing about cost of goods sold, and I don't have the definitive answer. I did actually talk to, I was on a webinar, a farm finance webinar, and I asked the person who was presenting about this, like, what do you use cost of goods sold for a farm where you're producing everything from scratch, right? Like for our t-shirt company, it's really straightforward. We buy those t-shirts. That's a cost of goods sold because it is the direct thing that you're selling, the direct expense attached to what you're selling. So if you're looking at it, if you're looking at an income statement, this gross profit line has its own line, the difference between your income and your cost of goods sold, because everything that you sell with your cost of goods sold is everything that you sell, the cost of goods sold is going to be directly applied to that. So it's like not as relevant. It's like more fundamental than anything else. Like it's more fundamental than what your revenue is in some ways, like what your margin is.
Subtracted from.
Yes.
Yeah.
So
does that apply for like the stuff we buy in and resell, like tofu?
yes. So thank you, Cheryl. Very good. You could be teaching us. So since we started doing
Listening on the side.
since we started doing a CSA, we have been reselling things. So I have all of those expenses listed as a cost of goods sold. So we buy eggs from Laughing Buddha. That is a cost of goods sold. We don't have any inputs into it. We're not like changing anything. We're not doing anything to it. It's just a straight in and out. We buy mushrooms, we buy fruit from places. That's all like we spend $5 per carton of eggs. We sell it for $6.50. So we have a $1.50 gross profit done. Then there's going to be other expenses off of it too. But that's the
what about
idea,
that?
right?
The percentage taken part, that's different.
That's different. I mean, you could, I don't want to talk about that because I haven't really figured out what to do about that. But
Never
yes,
repeat.
Cheryl, no, I'm not going to talk about it.
Not
I
worth
can't.
repeating.
I can't. It's too much. So I have promotional products here because we had some t-shirts that we saw, some River Queen Greens t-shirts. And that again, like we bought the t-shirts and then we sold them. Okay. What are we looking at now? That was the revenues. Are people pretty clear about how to think about revenues? Great. Okay, now we're gonna get into the operating expenses. Oh, if you could see me smiling. We've already actually talked about a bunch of this stuff, which is so great. Look, rubber bands was on my list, Cheryl, as farm supplies example of a direct supply. And eggs is the example of our cost of goods sold. Okay, so just really quickly, there's operating expenses, and then there's other expenses. We're not going to talk about other expenses right now. Operating expenses are the expenses that that's all the money that goes out of your bank account in the process of running your business. So you might have other expenses like your mortgage expense. Is that an operating expense? You know?
If the mortgage expenses are part of it,
If it's directly tied to the business.
I think so.
So what's an example of a non-operating expense? There's always other expenses like on a thing. Let me see. Other expense, reimbursement, blah, blah, it doesn't matter. Anyway, we're just talking about operating expenses and Marcus can't think of anything that's not, so it's not relevant. Okay. All right. So this hopefully is useful. I went through and looked at what the like big categories of operating expenses are when you're thinking about setting up your, this is going to be stuff that we looked at already in the chart of accounts. Shows up everywhere. Like I was saying, they all tie together. These are all of the elements of running your business. So you spend money on those direct operating expenses like seeds. You spend money on the general administration. All right, we're going to go through this piece by piece. I did this whole thing. Direct operating expenses. These are the most direct expenses that go into running your business. They're directly tied to your outputs, typically direct and variable expenses. So some people might call these cost of goods sold in some contexts. I don't do that. I don't use cost of goods sold for that, but if you wanted to think of it like that, because there's
Like a factory.
yeah, so well, a factory would have cost of goods sold because that would be like all of the individual parts that go into making whatever is a cost of goods sold because
Okay,
they're
so
like
it's more
buying it and selling it. It's I just think it's a little bit more complicated for vegetable farming because there's all of these different inputs that like sort of go in different directions and it's like kind of starting from scratch. But as we talked about before, direct operating expenses, seeds, that's pretty baseline. Like the more seeds you grow or the more seeds you buy, the more food you grow. Therefore, the more food you sell. So it's a direct operating expense. Gas and vehicle expense, like the more work you do, the more moving around you do, like things that are directly tied to running that business and like making it all happen in the moment, those are your operating expenses. So soil, this is like soil and soil amendments. Again, this is something that might not be variable, that might be a fixed cost because you're buying the soil for a whole row. Well, I don't know. It's like there's variations, like we talked about, that it's sort of an indirect cost that like you spread that compost on all of the beds, not just like you can't associate that one piece of compost with that one kale plant. But these are examples of just what goes into sort of farm business direct operating expenses. Rental equipment, you rented that equipment for one day to do the specific thing because you were doing it to run your business. So that's a direct operating expense. And then farm supplies. Good examples are rubber bands, paper chains for a paper pot transplanter. That's a really good direct thing where you know like that's something that's getting planted with the seeds. Like it's all part of those individual things that you're growing out of the ground. Packaging supplies, like we bag all of the baby greens in plastic bags. That's all direct operating expenses. Like each bag, again, like the rubber bands, each bag of greens that we sell, there's some amount of cost associated with it that went into that plastic bag. Twist ties. Seed trays are also direct operating expenses. And there's some variability here, and we'll talk a little bit more about that. Right. They're more indirect. Seed trays are indirect, but they are part of that like direct farming activity. Yeah. So this is where there's some things where like supplies that get used specifically for the sale of the items. And then there's supplies that are like used over time that don't all get used up. Like they don't get used for each individual item. You might reuse it like a seed tray, but it will have to be purchased again because they don't last forever. And it's directly tied to operating your business. Does that make sense? Cool. People feel comfortable. I mean, this is like 50% of the expenses on your list is going to be those direct operating expenses, probably, especially for a small farm. Like when you're starting up, like look at Laura's, let's look at this first fruit one. All of these expenses. So farm salary, that salary gets its own expense. Fertility, all of these things, this is all direct operating. Potting soil is direct operating. Seeds, all direct operating. Supplies, so she didn't categorize it as different things, but so like bins and baskets, stakes, trellising supplies, hoops, dip, like this is all stuff that you could categorize as direct operating expenses. There are some exceptions sort of that I think of that you might not think of, but like you might, in your head, you might think about it differently, but that's the way it's sort of a standard way of thinking about it. And then she's got this little business expense section, which we're going to look at next, general and administration. So this is more of the indirect costs, the like that farm manager that we were talking, or the factory manager who is not directly doing the labor, but you need to have a manager there to run the business. But it's not specifically tied to farm.
I mean, it usually is in the beginning.
Yeah. So examples of this are insurance, phones, professional fees. If you have to hire an accountant, that's not a farm expense, that's a business expense, right? Like it's like every business hires an accountant, hypothetically, or a lawyer or a consultant for something. That's all part of your general administration fees. Conferences and subscriptions. If you're subscribed to Growing for Market, that's a general expense. It's not tied to the like actual operating of your business. Office supplies, that's general stuff. It's like generic things that you have in your office. It's just general business stuff. It's not that like super specific farm business expense. Occupancy expense, this is something that is, I mean, it is relevant for farms. It might be a little bit different, like the way we think about it, because we're like outdoor based, but generally occupancy is the cost of being in whatever space you're in. So for us, we don't pay rent, but if we did, that would be an occupancy expense. We pay electricity and we pay water. So those are occupancy expenses. I also have our porta potty fee. I have that listed as an occupancy expense because it's like in the space that we use, it's like a facilities fee. We rent porta potties. Cool, huh? Payroll expense. This has its own category, and although it is directly tied to your operation, direct farming operation, payroll expense is often going to be your biggest expense. So it's useful to have it as its own category. It includes all of the workers, like your laborers who are in the typical farm or factory or whatever are hourly, and that's your direct labor. And then you've got your managers, which are typically salaried, and that would be indirect labor. You could include yourself here if you're paying yourself a salary. And then all the associated payroll taxes. So like I was saying before, for your salary, you generally add 10% for payroll tax. If you were paying health insurance for your employees, it would go under payroll expense too, and other like benefits to employees that would all go under your payroll expense. And that is typically like, I don't know what the typical number is, but it's normally over 50%. In many places, a lot of businesses, payroll expense will be like 90% of their expenses, total operating expenses. It's definitely the highest single expense for us too. Worth it, says Cheryl. Repairs and maintenance, I'm not gonna go through like details of this, but like we talked about a little bit with Michael before, you just want to have you want to have it in your budget for covering things that might come up, and then if they do come up, you put it in your as an expense. Okay, so like for example, we pay Maggie's husband Jacob to mow the outside of our fence line on Kentucky Street. So I put that under repair and maintenance. It's just like general maintenance that just once a month he comes and does it. Maybe not once a month. What?
That was Maggie's husband.
Yes, he is. That fine looking fellow. Okay, supplies and equipment. This is where not everyone has this as a separate thing. Some people would put supplies and equipment or supplies under direct operating expenses. I like to have it be separate because of sort of what we were talking about with like seed trays. And I was looking through like different accounts and I haven't been super consistent with this, but I think I'm just going to introduce this idea to you. I think of these as like mini assets. They're not things that go in your balance sheet because they're less than $500, but they're things that have value over time. It's not just like a one-time purchase and you sell like a rubber band is something you buy it for one thing and it goes out the door. A hammer is an expense. It's not an asset. You can't say that you have a hammer, like a $10 hammer, right? But it has use over time. It's not just a one-time out the door thing. So I think of that as being more of a fixed cost, where like, you know, you're gonna have to buy a certain amount of supplies continuously or equipment continuously over time, but it's not gonna be directly, like the hammer isn't directly tied to the vegetables, right? There's like a space between that. So I put that under my, that's my small tools and equipment. I also have like irrigation supplies under there, but some people would put that under their direct operating. But
We irrigate so infrequently, or like.
yeah, I mean, your irrigation, hopefully it would last more than a year, you know? So like direct operating, I think of as things that are like sort of one-time things that are out the door. And maybe I'm not thinking about it right, but it's just how I think about it. And you would totally get away with just putting all of that under your direct operating expenses.
But I agree with you, Annie, that this is very helpful to further break down because I have struggled with these exact categories. And it is like, you can give a time, like say greenhouse plastic, you know, you get 5 to 6 years out of it. So you like, it's like semi-fixed, but you can predict when you are going to need to replace it. Sorry, my neighbor's fixing his motorcycle, in case you can.
Yeah, but so that's an interesting example. I would put that under small tools and equipment or building materials as like things that last for a while, but they're not like such big purchases that it would be a fixed asset.
But you wouldn't sell it.
Yeah,
Does
it
that
will
matter?
use up its lifespan on your site. You're not going to be selling your crappy plastic. I mean, I hope you don't.
Your enterprise.
I made a note here that I put a lot of stuff separately as a supplies instead of direct operating, because in the beginning we were buying so many things because we were starting up the business. So like, it was like we were developing these assets, you know, it was like accumulatively we spent probably over $5,000 on little things that don't show up in our fixed assets, but I didn't want them to show up in our direct operating expenses because they're things that we still have now.
So like, we just got a bunch of new hoses, where would those be direct operating, or would they be?
I would put it under small tools and equipment.
Okay.
Yeah, I mean, some people might put it under direct operating,
Okay.
but I like to think of direct operating as things that are out the door,
Gotcha.
in and out. Tax expense, we don't have to talk about that. That's payroll taxes, or if you pay sales tax. I'm not going into that stuff right now, but that's another category. Okay, are people doing well right now? Are we like done? Okay, I'm gonna touch, I think we already did. I think we went over balance sheet. One thing I didn't mention about the balance sheet is that it's a snapshot at a given time. So the difference between, I mean, they're showed different things, but an income report, when you're generating your report in QuickBooks or whatever you're using, you set a time period. So I would say, like, if I wanted to see how I did over the month of November, which just finished, I would say November 1st to November 30th, I would run the report, and then it would show me all the sales in November 30th or in November and all of the expenses. If I wanted to run a balance sheet on November 30th or on December 1st, let's say, I would just put in one date, and it just shows you exactly what money is where within your business at that moment. It doesn't track time like an income statement does. It's a snapshot. That's something that we talked about a lot in my accounting class. Anyway, okay. You guys remember assets equals liabilities plus equity? That's like the basic thing about a balance sheet. All right, we're gonna look at cash flows. This is what made Chelsea freak out. Okay, I think, yeah, no, Laura has it here. This is great, I love this. Okay,
Jesus.
so cash flow is actually, again, it's basically the same thing. You're gonna see these things, they keep coming up, right? You've got your income, you've got your expenses, and you have all of these different things, right? Like, this is the same general format every time in your budget, in your income statement, and in your cash flow. All of this information looks pretty much the same. Like, these categories are all the same. What's different is that this is I think this is probably a projection. You could do a past cash flow, but it's probably a projection. And the idea of cash flow is, it's specifically how much cash do you have at any given moment? Or like, when are you spending money and when are you getting money? And it's going to change seasonally. I mean, a farm is a really great example of a super seasonal business. Louisiana is a little different because we have a 10-month season, but this is helpful here. First Root Farm was in Massachusetts. So the growing season was basically like May through November, we'll say, which means that you're going to be, if you look at this income, the CSA was, okay, so CSAs was all pre-sold shares, but the income came in. These are the months that the income comes in. So they sold $9,000 worth of shares in January, 11th, and this was all stuff that was pre-sold for the season. And by June, they were done selling shares, which means, look, they had no more revenue in July and August, even though they were selling stuff, but
Distributing stuff.
they're
Already
distributing
sold.
it. It was already pre-sold. So the way a cash flow works is you just look at it, just look by column. So we're going to look in January. Total amount made, total revenue here. This was the expenses in January. At the end of January, she's left with $9,436. That's the revenue minus the expenses. Then what you do with your cash flow is you add that to the top. So you know you're going into February, you have that cash in your hand. And then you just look at, so February, you put your profit and loss statement in February. And these are the numbers that she came out with, you know. She made $20,000 in February, or that's plus that. So she actually made, yeah, so this doesn't have exactly how I would want to do it. I would want to say it's the income minus the expense. That didn't like what I just did. What did I just do? So it's $10,000 plus the beginning value, right?
Mm-hmm.
And you just go through like that. And the reason a cash flow is important is because if you are like cash-based business, you need to know how much money you have to spend at any given time. And if you're like, you're going to make decisions about when to buy things based on this. Like if you know that
Or when to hire.
or when to hire, or buy things, or when to spend money.
Like Ellis was like, oh, I'll hire someone. Now I'm doing markets and I have cash flow.
Right. Yeah. So it's just a way of thinking about how your business operates in a year. Because it's going to be different. Like a lot of businesses, like a retail business might have a huge cash flow in December, but then they're not going to make any money in January. In fact, they'll probably lose money in January because everyone's like returning things. Or, I don't know. So they're going to have to make their hiring decisions and like purchasing decisions based on when that money comes and goes. Okay, that's basic cash flow stuff. Cool. And then the last thing that I have, oh no, two things. Okay. So we've talked about all of these different parts of your finances, your record keeping, and there's different ways to track it. So the most basic way, the way that First Root Farm did, I think, was with an Excel spreadsheet. And you can totally get away with doing that. I'm pretty sure that's what Ellis uses. And using Excel, something like this, like any of, actually not that, like this, or like the Carrot project here, they budgeted in it. You can build out your whole chart of accounts, and then every time you enter an expense, you would like have a separate page probably, and it would like automatically add to it. I've never used Excel for doing that. It seems very clunky to me, but it's also like pretty straightforward and basic. You don't have to like pay for a like account for QuickBooks or whatever, and you might have to pay to buy Excel, but you could also use Google spreadsheets. That's probably fine. It's a good way to start. Just start tracking your expenses. Just like start writing a list, say what date you bought it, where was it from, how much was it for, and then assign an account. That's the basic information that you're going to put in for your expenses.
Yeah, I feel like you know when it's time to upgrade.
Yeah, I mean, I'm amazed that Ellis is still doing it, but he's like got his systems, so that's great. The other thing that's cool, I mean, I don't know if you're an Excel wizard, like you can do so much with Excel. It's super powerful. There's like all these formulas, you can do all sorts of things, but you have to know how to do it. So it's also nice though, like there are templates, like you could use the template that I used with the carrot project to set it up. Like there are things you can use, you don't have to build it all your formulas from scratch. I also, as I said before, I think it's useful for budgeting. So you can just see everything out there together, and then you like add your whatever % addition you want to add for next year. You can just see that laid out nicely. And you might end up using a combination of Excel and QuickBooks. So we use QuickBooks. There are other accounting softwares like Quicken, and there's others, but QuickBooks is kind of the standard for small businesses at this point. I just transitioned from QuickBooks Desktop to QuickBooks Online. I am not an expert in QuickBooks Online at all, so I don't want to talk that much about it, but that's what you should probably do. QuickBooks Online. There is a fee, it's a monthly fee. So it might be cost prohibitive at first, which is why you might want to start with Excel, and then when you're ready, you can transition to QuickBooks.
How much is, do you mind telling us?
Yeah, so there's different levels. They have like a very simple starter level, which is more, I think, for like personal finances. That I think is like $15 a month, but they currently have like a 50% off for the first 3 years or something. They're just trying to sell them. I don't know. And then it goes up from there. I bought the second one, which is Enterprise, which I think it's $35 per month, but we're paying 50% off right now. So, I mean, it's not a huge expense for like a business. It's not a big expense. And considering what you get from it, it's definitely worth it. I was just sitting tight on my desktop version, which was from 2012. It's totally outdated. There's no support for it, which has been an issue, which I don't want to go into it. It's too painful, but it is. You could get a desktop version, and that if you did desktop, you would just pay a one-time fee to purchase it. I don't think there's like a relicensing fee. I certainly never paid a relicensing fee, but there are definitely advantages for the online one. Some of the advantages just in general, I mean, QuickBooks is built for doing these things. So like you put all of your expenses and revenues in, and then it creates all of these reports for you, and you can organize it. It's very organized, streamlined. You can invoice with it. I don't know how Ellis does his invoices. He probably has to he probably has some like Excel template that he fills in, prints out. And then the super nice thing about QuickBooks Online that I'm just getting used to is that it talks to other sites. So it's connected to my bank account. So I can just like reload, and it will put all of the information going into my bank statements into that. So I have to do a lot less work now.
You also can access it from multiple places.
Yeah, and then QuickBooks Online, I can have it as an app on my phone. If I'm like dropping off some stuff and I forgot to create an invoice, I could make an invoice on my phone and email it. I think it also has a way of scanning receipts on your phone, like in real time. You don't have to do however else you might do your receipts. So, I mean, I recommend QuickBooks. I'm not a QuickBooks expert. I'm hoping to be better at it in the next couple of months as I get used to the QuickBooks Online, but it is like, it's pretty standard stuff, recommended. And then here's just a couple other things that we've used for
Can I
other,
Something about books real quick.
yeah, sure.
That okay, this is gonna be, you will see my food safety nerd come out. But we made there's a video that exists that shows you too how to use QuickBooks to create the financial records that you need to prove where you fall under the produce safety rule. So it will show how you group things and whether you sell it direct to consumer or wholesale, because that lets you know if you are exempt from the rule or qualified exempt.
Cool.
Just throwing that out there.
You guys probably know, I don't know how much you know about produce safety stuff, but that's,
You mean you're not teaching it to them?
that's gonna be our January.
You're gonna teach it to them.
We're talking already. No, that's what Marcus is doing.
Someone's teaching.
Okay, so a couple other things, just like these are other apps or whatever that we find useful that I would recommend using. We use a mileage tracker app. We use Everlance. There's other ones out there.
Probably better ones.
Mileage is something that you can track and write off. So it's recommended that you keep track of distance traveled when you're traveling for work. And there are apps to track that for you.
Yeah, it's just like a map that calculates mileage.
Yeah,
calculates
you
the
just
expense.
put in your input, your
starting
start
point.
and end point, and it will track it for you. And then you can like have a report at the end of the year, and you say, okay, we drove this many miles, and then there is a standard business rate to calculate what the cost per mile is. Right now, it's like 56 cents per mile. So then I'd put that in as if I put it as a general and administrative expense. I could maybe put it as a direct operating expense, whatever. And then it just adds into your expenses, and then that means that it's a write-off for your taxes. We use a scanner app called JotNot that my brother-in-law made many years ago. You don't have to use JotNot, or if you have QuickBooks, you, I think, can scan receipts directly into it, but we use it for receipts. So every time we have a printout receipt, we scan it and we put it in Dropbox so that all of that information is saved in one place. We don't hold on to paper receipts. Some people definitely do, and you can do that if you like to do that. Cheryl is the most anti-paper filer I've ever met. She thoroughly rejected my file cabinet that's like this big. She wanted me to get rid of all of my files. I was like, no, I have use for these. She's like, just scan it.
What were you saying, Nora? Oh, you can scan with Dropbox now. I don't know if you always could. Oh, you can scan receipts with Dropbox? Yeah, I think that's a new feature I've seen.
Yeah,
No,
sorry,
so
Abe. You're
we can cut out the middle apps.
Yeah, but we recommend scanning receipts and not just filing them forever.
They also get nasty, like they're on a farm.
Yeah, that's true. So I don't think all bank accounts, hopefully most bank accounts now, but maybe some like credit unions don't have mobile check deposit systems, but definitely recommend using a bank that does, because you're not going to have to go to the bank every time you. I mean, it's 2020, folks, which is a terrible year, but at some point we won't be in 2020 anymore. You should be doing mobile deposits. You don't have to go to the bank for that. And then this is sort of a side note, but we use a third-party payroll system. QuickBooks actually has payroll, which is cheaper than what we use, but my understanding is that it's not as great. So I really like ours. We use Gusto. And for a monthly fee, I think the baseline is $45 a month. They run all of our payroll. They do all the direct depositing. They do all of our payroll related tax reporting. So I don't have to think about that stuff, which is like huge relief. Don't want to have to do that. And I'd much rather have people who know what they're doing do it. Because if you mess it up, then it's like way more expensive than just paying for people to do it properly. Okay, so that's my presentation. I have some resources here that I recommend people to check out. There's an organization in Massachusetts. Can we just lose power? The internet. We're still connected to the internet. Oh, maybe I just blew that. Maybe it's just that. But you guys can still hear me, right? Maggie? Okay, thank you. I'm looking at you, Maggie. You're the only one on my screen. Okay, so the Carrot Project it's a nonprofit organization in Boston that does like small financing for like small loans for farms in the Northeast, but they have this really, really useful website that has all of these resources, including webinars. This budget that I pulled, that's from the Carrot Project. They have a, do I have it on here? Oh, they have like business plans. Like they have like a business plan sample that I was looking at a little bit. Yeah, a farm specific business plan, which I think is helpful because there's lots of business plan things out there that aren't going to be as helpful. Anyway, I recommend checking them out. It's just thecarrotproject.org. And then they have like resources, like a drop-down menu with resources that you can check out. Farm Commons is more for legal resources, but I think they have some sort of like general businessy things. It's all about farm specific business stuff. Just useful, cool, free resources that are out there for small farmers. There's this guy named Richard Wiswall. What did you call him yesterday?
Farm bro.
Farm bro. He's a Vermont farm man who is making money off of being a farm expert by selling a book called The Organic Farmer's Business Handbook, I think.
Which we have, so you don't need to buy it.
We have it. It even has a CD-ROM in it, which is not useful for me. I think there's a CD-ROM.
Classic.
Yeah. But his book has it's much more detailed information than what we did today, but it's like, how do you figure out how you're making a profit off of each individual thing that you're growing? It's just a much more strategic kind of way of thinking about farming from a profitability standpoint. And it's fairly small and, useful. And then there's more like generic business support organizations. There's SCORE, there's SBA, Small Business Alliance, and the FSA and USDA. All of those places have information, but I definitely recommend the Carrot Project for like really great resources for thinking about like record keeping and other things like what we're talking about today.
I do also just want to say that sometimes when it comes to SCORE and SBA, their mentors might lack experience working with farmers. So it is just nice to ask up front if they have anyone that has worked with small farms before. And I think Monica Hernandez, she's out of Lafayette. She's a SCORE mentor in Louisiana, and her partner runs a farm in Lafayette. So she could be a resource.
Great, thank you. And that, my friends, is it. How'd we do?
Great. Are you sending out this slide?
For real.
Yeah, I can send out the slides.
The whole recording.
Great.
That was really great. You